Yes.
Perfecto. Bueno, pues muchísimas gracias a todos por uniros a a esta nueva conferencia organizada por el Comité de Sostenibilidad de Fecha Society Spain. Primero me presento, soy Íñigo Serrats, CFA, Managing Partner de Impact Bridge, una gestora especializada en inversión de impacto, y luego pues miembro del Comité de Sostenibilidad de CFA Society Spain. Es un placer contar con todos vosotros y de nuevo pues daros las gracias en nombre de CFA Society Spain, en nombre también de todo el Comité de Sostenibilidad y, por supuesto, en nombre de nuestros patrocinadores, que contamos pues afortunadamente con Aberdeen, Amundi, BlackRock, GAM y, por supuesto, Federated Hermes como patrocinadores de nuestro comité, que gracias a su apoyo, desde luego, pues muchas de las actividades como esta que llevamos a cabo, pues son posibles, ¿no? Y hoy, bueno, pues es un gustazo y un lujo para CFA Society Spain contar con la presencia de Luis Dudley. Esta conferencia titulada Navigating Challenges, Equity Markets and Best in Class ESG Integration no podía ser introducida mejor que por pues una gestora como Federated Hermes, muy distinguida en todo su acercamiento a la sostenibilidad, y concretamente en el caso de Luisa Dudley, CFA, pues de nuevo un placer tener a alguien pues tan distinguido y con tanto recorrido, ¿no? Es miembro del Consejo del UK Sustainable Investment and Finance Association. Ha trabajado en Federated Hermes desde el año 2009 y, bueno, pues es probablemente una de las mayores expertas que hay en cuanto a integración de factores ESG, enfocado desde distintos ángulos, y hoy, pues bueno, va a ser un gusto contar con ella. Y bueno, I'm going to move to English, Luis. So thank you very much for joining us, and we are delighted to having you with us, as well Carlos Capella as country head of Federated Hermes in Spain. Thank you very much, Carlos, for your confidence and for sharing with you your perspectives. And well, Luis, this is your audience, so please feel free to share. And well, we are very interested in learning what you're going to tell us today. Thank you very much.
Thank you, and good evening to everyone. Thank you very much for the opportunity to speak. I am a CFA myself, and certainly, you know, ESG is a journey, and certainly maybe this year has been quite challenging for equity markets. So, you know, to talk on these topics, hopefully is very relevant, and I'll got three different sections really. First of all, really an introduction to kind of what's setting up kind of responsible investing, ESG considerations at the firm level, and kind of that framework. Then also what we do. So as kind of mentioned, I've been doing this for a number of years. Some of the practices that we implement within our strategies at Federated Hermes. And then I'll go into a little bit more kind of current market context, some of the current challenges, and particularly, you know, ways to kind of overcome that, and certainly the way we're being able to navigate those difficult markets at the moment, and hopefully some good pointers there, and we'll hopefully bring forward some good questions as well for the end. So first of all, kind of getting started on just at the highest level in terms of when we're looking at measuring and quantifying sustainability, you know, how do you get started? How should this be appraised and considered? And one of the frameworks that I quite like, that has been used kind of over the years when we talk to clients, and often clients are quite interested in understanding the answers to these three questions. It's quite simple in a way, is the who. So is it an individual? Is it a whole team? Is it integrated through everybody? Does, you know, the CEO and the top execs also have an ESG or sustainable mandate? All these things are quite important. What is the background? What is the experience? And to a certain extent, you can get to that first level of thinking, what do we want in terms of that? And it may be a case of adding additional resource perhaps, or it might be, particularly when it comes to engagement, it might be about what are those specific skills that you want that go alongside those investment skills as well. So the what just goes into that next level of what are you trying to do, what is your objective, maybe what is your policy, and in that way just getting to that next level of granularity of answering that question. And then finally how you're going to do it, and for a lot of firms this will be, you know, maybe a 5-year journey from starting to understand the ongoing training. You know, there is now a plethora of data and different approaches to ESG, responsible, sustainable. We've obviously got lots of different regulations coming in as well. But, you know, putting in a framework about how you're going to get there, what needs to be tackled first, what are those high priority areas. And certainly, you know, the latest priorities that we're seeing, which are coming through, are definitely around climate, and what is the positioning there, and what does sustainability and that climate consideration move, but also human capital considerations as we move into this service-based economy. That's another kind of high priority area that people are looking at as well. So you need the frameworks, the processes, not just to implement it, but to be able to do it on an ongoing basis as well. Moving in from that kind of high level framework, on the left hand side just highlighted some key questions that again you might want to think about when framing what you want to do and how you want to do it. And these are some of the questions that you know, to a certain extent are kind of the next level within that framework. Just to highlight, there are a number of global frameworks that have been out there for a number of years. So the UNPRI, as financial institutions, I'm sure many of the firms you're working for are members. So that's been around since 2006. Federated Homes, we were one of the founding principles of that, but there are also other initiatives. So the UN guiding principles are being used a lot within the new EU frameworks in terms of do no significant harm, for instance. These are also sometimes termed international norms, so they can be used for screening companies. And to a certain extent, they can be either seen as minimum standards or kind of best-in-class standards, depending on how they get applied. GRI, a framework that companies will report against. It's a very kind of common framework, and SASB, a framework that's kind of come out of the US that again has got a lot of traction as well in terms of assessing companies, what companies need to do. All of these are useful frameworks for understanding when thinking about sustainability. And to kind of help understand some of those frameworks, some examples of some of the data providers which, you know, have continued to gain momentum and gain presence within the market, and perhaps led to some of the challenges that we now see in terms of market dominance, in terms of certain ratings, but certainly some of those data providers bringing together or standardizing frameworks such that investors such as ourselves can make use of those. And they all have slightly different philosophies, slightly different approaches, and so actually, you know, to a certain extent it's useful appraising each of those as part of your understanding when it comes to sustainability. In terms of when we're looking at best practice ESG, and just to give you a bit of a hierarchy of, again, where you might go in terms of that journey, what we see is a kind of an entry level is looking at those high level ratings that come in from the data providers. So again, that's a kind of a light touch type approach. It can be used for screening, can be used for assessing companies, but the understanding perhaps isn't going to be there. And so that's really an entry level type approach. Second of all, it is really going to that next level of materiality and considering which metrics are most important over what time horizon, being a bit more proprietary in terms of your thinking, being a bit more unique. How does that apply to a specific investment process or an asset class? Is really kind of stage two, kind of building on once the understanding of the ratings is there, I would say. And then the top level is on top of these things that we think is essential to really get the most from ESG considerations and sustainable investing, is to also do that active ownership or engagement as it's known. So talking to companies, understanding how the leaders within these businesses are responding to either new regulations that are coming out or how they're addressing current issues that they might be facing. And often it is to do with future strategy, that we can get a bit more qualitative information from companies through this ongoing dialogue. And also through that engagement, you can also measure kind of tangible impact or action against achieving some of the objectives that are, for instance, set out within the PRI framework. So that just kind of gives you a little bit of an idea, and certainly it's a framework that we see asset owners using, for instance, when they're assessing asset managers, to kind of really understand a bit more about kind of what best practice looks like. So now I'm going to go into a bit more detail in terms of what we do, just to give a bit of flavour, a bit of example. So this framework here just goes into a level of granularity in terms of, again, kind of to a certain extent, it's a three-stage approach. I'll start at the bottom, so at the security level. So how are ESG considerations being integrated within that individual company analysis? And that's something that can be done either through a separate team, through a framework, or can be done by the investors themselves. And we see that as the kind of the best approach if it is fully integrated, making use of a lot of the data that's out there, but also combining that with more qualitative insights as well. Building on that, it's also important to consider the positioning of the portfolio. So it's all well and good having maybe rules around what you do and don't like at a stock level, but perhaps you might want to change what the overall portfolio looks like, and perhaps what those portfolio outcomes might look like as well. And certainly, again, some of the regulations that have come out more recently are talking very much at the portfolio level, more than at the individual stock level, but it's important to have different criteria, for instance, for each, and particularly on the portfolio level, that's when kind of reporting and transparency becomes quite important, and it's important to have sophisticated tools to be able to do that. And then finally, at the firm level, so this will be like the Federated Hermes level, what are we doing to continue to be a positive change within ESG and responsible investing? And that includes some of our public policy advocacy work, being good stewards of the assets that we run, being transparent about our processes, but also maybe being part of some industry collaborations that are out there, such as IIGCC or Climate Action 100, or on the more kind of social side, maybe Advance, which is the new PRI engagement initiative that's coming out, might be something. So dedicating resource at a corporate level is also important as well. Going into the stock level into a little bit more detail, and this is an approach that we've built up over many years. We see the real benefits of having this hybrid approach of using quantitative plus qualitative signals. We know that ESG data is not perfect. You know, that's part of the challenge that we've seen more recently, or pushback in terms of ESG ratings, or wanting to have a single score. We recognize that companies have diverse businesses. Often they're across different jurisdictions. They're rarely perfect. There will be strengths and weaknesses. And so therefore, you can put a quantitative framework around it, but it is important to overlay that due diligence in terms of qualitative understanding, and also particularly being able to assess those metrics which maybe you can't kind of put a single number on as well. And also when it comes to some of the quantitative data, it does tend to be more backward looking at the history, looking at how companies have reported, whereas in that more qualitative judgment, we can look further forward and take a more subjective view. So we think that's important to think of both. One of the benefits of the quantitative framework is that you are able to build a back test, or even kind of demonstrate through actual kind of real life returns, the benefit of some of the quantitative metrics. And you may well have seen some similar studies across certain ESG providers that are out there. We have our own quantitative ESG metrics, so a QE, QS and QG score that is shown here. And here, these are actual the returns, so the evidence of why we think incorporating these quantitative factors within our valuation models is actually crucially important and is going to add alpha. So historically, this would have helped to overcome certain queries that we might have had around fiduciary duty, around missing out on return. Here we can demonstrate the evidence supporting the alpha behind the ESG. And what's really interesting in terms of the metrics that we've put together that are a bit more unique is that we've incorporated momentum within our score. And here what we're showing is the difference between the companies that rank best, so the top decile, and the companies that rank worst in the bottom decile. And what you see is a very significant underperformance from the companies at the tail end of that distribution. So those are the companies which are worse than peers, but are also not changing. And so that's quite an important consideration rather than just saying good and bad. You're also taking into account that change, that momentum, and that forward-looking outlook within your assessment. And so we think that's quite clear in terms of identifying those laggards, given that the ESG space continues to evolve and adapt. Identifying those laggards are those that are more likely to be caught up in controversies or negative behaviours, and perhaps be penalised by clients or within their supply chains, for instance. And so we see this as quite a clear study. We first produced this back in 2014. It's continued to get stronger and stronger, and particularly on the governance side, it's a very persistent signal. And we see it actually as the most kind of leading indicator for good E and good S practice. And that's something that, as I say, has been very consistent across regions and across the majority of sectors as well. And we have some further papers available should you have further questions on this. As well as having that quantitative metric, we also have a philosophy. And so we take the full investable universe and break that into 3 areas. And we use the quantitative metrics to try and discern which of these buckets certain stocks fall into. We do see the majority coming into the middle, into that potentially attractive. We kind of don't waste our time with the ones at the tail end that we know are the laggards, that are the underperformers. And then we perhaps spend less time at the top end of the distribution where a company looks particularly good. And it's more in the middle, the potentially attractive areas where we're applying our experience in terms of materiality, in terms of ESG improvements, to discern kind of what's good and what's not good and what makes it into the portfolio. But being quite clear with clients about what we're setting out to do means that they can look at the portfolio and they're not perhaps shocked in terms of what's included or what isn't included. They know what they're getting when it comes to how we're thinking about ESG integration. As well as on the kind of quantitative side, when it comes to the more qualitative assessments, we've also built a number of tools. I mentioned that there's lots of data out there now, and so bringing that information together into decision useful analysis for the portfolio managers, for the analysts, to have a consistent way of looking at that data is useful. And so that's how we've kind of built out these tools. And also crucially, we've got our own internal stewardship teams that's known as EOS at Federated Hermes. So they generate engagement insights into companies, and we actually kind of take their data and feed it into these tools such that we're able to use it within our investment decision making. And that's obviously a leading practice. That's not something that's necessarily available to everybody, but we see that as a real kind of key value add, and certainly having those up-to-date assumptions when it comes to how companies are thinking about ESG is crucial to our approach. Finally, just before I kind of go on to kind of the more kind of latest comments on the market, just to highlight, when it comes to ESG, one of the questions is, isn't ESG just growth? Or isn't ESG just quality? And here, just showing the style positioning of our ESG fund. And you can see in terms of value, growth and quality, actually, you can see that you can get positive exposure to these attributes, as well as having kind of positive ESG metrics as well. And you will see from some other portfolios, particularly if they are maybe more in the kind of Article 9, more clearly sustainable thematic, that they may be more concentrated within growth or quality, for instance. But those are really just one type of ESG investment styles. And actually here you can see this is a more ESG integrated type approach, where we're taking ESG considerations alongside other financial metrics into account. And certainly in terms of delivering performance, it's a bit more stable than a portfolio which is highly concentrated within just growth or quality, particularly with the recent volatility in those factors in terms of performance. So now I'll just spend kind of 10 minutes or so just kind of talking through some of the latest things that we're seeing, and certainly what's been driving the market more recently. And our biggest two kind of headwinds or kind of challenges that we've seen as global equity investors is the macro-driven market, that it has been so volatile based on some of these top-down indicators, so less driven by the fundamentals of individual companies and more just driven by that kind of top-down impact. And obviously we've had the war in Ukraine that kind of followed on from the kind of COVID rebound, when we kind of had all the economies going again. So we already had quite a high oil price when we then went into this more constrained energy environment, particularly for Europe, which led to this high oil price, which we haven't seen for a number of years. And certainly when a number of years ago, when a number of people were getting quite excited about ESG investing, a lot of that was actually maybe more the energy underperformance rather than long-term sustainable investing. So just to kind of caveat that to a certain extent. And then second of all, from an interest rate perspective, that has driven a lot of the volatility and certainly those changing environments. And so the chart that we used to just kind of show how extreme the market has been in the last 12 months is our risk aversion indicator, which we use. It's based on 9 underlying indicators across asset classes that we build into this proprietary indicator. And here you can see the percentile score, and you can see that it's barely left that kind of top 25% of risk-off behaviour from an equity perspective. So that's been quite a challenge in terms of positioning relative to previous periods that we've had. And I mentioned in terms of the fluctuating interest rate expectations as well, having come out of a very prolonged low interest rate environment for many, many years, and certainly growth companies being able to deliver quite exceptional returns within that period. We're now into this new period of higher interest rate expectations, but then also expected to come down next year as perhaps maybe some of the recessionary type implications come in as well. So quite a difficult environment to be maybe long-term sustainable, and some of the maybe growthier areas, some of the more thematic areas have certainly been challenged in this higher interest rate environment because their growth rates have had to come down because of the forward modelling that we're looking at. And so just to highlight kind of one of the biggest trends that we've seen for the year and just the scale of that, just showing the performance of the energy sector relative to the MSCI World Index, and also relative to the utilities sector as well, which contains a lot of the fossil fuel names. So a lot of ESG investors will be underweight to the energy sector for some of the reasons shown there, that it is hard to buy credible companies when it comes to kind of ESG, particularly because of the environmental footprint of those energy names. A lot of them have been laggards in terms of delivering transition pathways. And certainly some of them even facing litigation, other reputational risk as well in terms of how they operate their business, because it is a high risk type environment, and because we are seeing more regulation, these companies are, are hard to own to a certain extent in terms of fulfilling the criteria under ESG. And the size of the discrepancy in terms of returns has obviously been quite extreme following quite a strong period of underperformance for the energy sector. So here we're looking at almost a 40% difference between that energy sector and the rest of the market. And so therefore, even being marginally underweight in terms of a lower footprint or in terms of a sector underweight, it is going to have hurt returns year to date. On top of that, we've also seen quite a challenging environment in terms of the value versus growth dynamics. So this has upset a lot of investors. Where we did see quite a concentrated growth market, we have seen quite a strong underperformance, and a lot of that being led by that change in interest rates and the change in the 10-year yield, which again continue to get higher and certainly beyond what we've seen for a while as well. And so in that way, quite difficult as investors, and certainly we had even very strong intraday moves for a lot of this year in terms of the value versus growth trade, with a lot of investors being caught perhaps on the wrong side of some of these names, and some of those value sectors such as energy, such as financials, have not been able to perform because of interest rates and because of the volatility that's been there, the additional costs that they're facing. And for us, I showed the kind of the style positioning of our portfolio earlier. For us, kind of really recognizing that it's better to be more balanced, more diversified in the long term. And so here just showing a couple of metrics in terms of efficacy of some of the signals that we use, and particularly highlighting that combination. So being more balanced, being more core as an investment style does lead to higher overall outperformance. So you can see the combined factor from an IC and also from an effectiveness perspective is also most durable in the long term. There will be obviously periods of volatility, and we've seen that this year with the rebound in value and the underperformance of growth for many months so far year to date. But the combined signal gives you that overall kind of best opportunity set, and this is numbers going back to 2013, so quite an extended kind of back test on those factors. So just to really kind of wrap up there, so you can see kind of year to date, quite a challenging environment, but certainly being able to overcome it partly because of the ESG integration that we have, and particularly the governance metrics which fall into that corporate behavior factor. The predictability of that factor holds up irrespective of the market environment. In particular, also where we focus on change in companies, so rather than just buying best in class, and you could take that from an industry perspective, or you could take that within a sector perspective. Rather than just looking at the best in class, you can broaden your investable universe by looking at not just those that are good, but also those that are improving or expected to do better. but also to be diversified when it comes to ESG. So don't be too narrow in terms of just kind of growth or quality, but actually there are ESG opportunities across those investment styles, and that gives the kind of the maximum opportunity to deliver that consistent outperformance in the long term as well. And with that, I will hand back to our host, and happy to answer any questions.
Liz, thank you very much. Very interesting. So one of the questions that I have, looking backwards, in my previous experience, I used to be responsible for ESG investments at CaixaBank Asset Management, which is an asset management company here in Spain. And one of the things that was really challenging was engagement, right? So well, I'm talking like 10 years ago. So since then, there has been a lot of evolution. So how do you see the evolution in engagement with companies? Because back then, it was really difficult to be heard and to be listened by companies. So how do you think that change has been, and how difficult or easy it is for you to get in real engagement? Because talking about it is easy, but doing real engagement, I think it is very challenging. How do you manage that?
Yeah, so for us, what we've done is we've set up quite a disciplined process in terms of, on an annual basis, we put together a program of specific companies that we've identified through a combination of metrics. So that's to do with the size of the holding, the ability to affect change, and also the severity of the issue. And we create an engagement program. And typically those are companies or things that we'd like to talk to companies about, where we have a 3-year horizon, and we identify specific objectives that we'd like to achieve within that time. And we measure progress within those 3 years, or in terms of how we're getting on with that engagement, using milestones. And in that way, we can be quite transparent with, our clients in terms of how that's progressing, and also being able to monitor how the company is initially acknowledging the issue, but then also putting in place a plan and then kind of implementing that plan. So that can be quite useful for us to be able to demonstrate that change and to ensure that we're on track. One thing perhaps to acknowledge is that it doesn't happen overnight, that sometimes it can take, although our aim is 3 years, sometimes it can take 5, 6, 7 years to get into talking to the right person, persuading those internal stakeholders perhaps, or maybe strengthening those internal stakeholders to take the right issues to their board, to be able to get it acknowledged and get it changed. But I think through having this long-term, quite transparent approach, we are able to effectively push for change. I think we do also act as real partners with the companies. So, we'll share best practice from peers that we've seen. We'll encourage them to ask the right questions. Have they considered this? We act as kind of trusted partners in terms of if they're putting out a new policy or a new plan, we'll offer comments of how they can improve. And in that way, it works quite well. As you mentioned, definitely it is easier to get access, and we are seeing a more open door when it comes to engagement, and that's very useful for us. But at the same time, we're also seeing more greenwashing of people being quite good at being able to talk what they should be saying, but with maybe little specific details. So therefore, it's important to have that list of questions up front, be able to really interrogate the right people on the right issues, and also give them something to think about, I think, while also being collaborative and acknowledging that, we are there as long-term investors, but we do need to see these things change in order for us to continue to maintain our investment within that company, for instance.
Do you see other competitors of yours aligning with your views, or do you find a lot of cacophony, making it more difficult even to defend your interests versus others that have like other potential interests? So how do you manage that, and how can you, you know, influence better those companies instead of making them listening to others? How do you manage that?
Yeah, I mean, in general, we may well have similar objectives to other investors, and you know, if it makes sense to collaborate. So, for instance, you know, we are active members of Climate Action 100. I mentioned also the Advanced program, which is the social program that's coming out in January on social aspects of engagement. So, if we need to collaborate and if that's effective, we're happy to do that. We do sometimes find that it's more effective to do it behind closed doors somewhat. So we're not too vocal, such as some other investors maybe are a bit more activist. We want to be able to tell the story almost once we've had the success, but we don't use the media in that way to kind of activate for change in that way. But yeah, we will collaborate. I think, you know, maybe one of the hardest things is when we do meet with investors, if, you know, management might be skeptical about ESG or what we're trying to achieve. But I think often we manage to win them over through our hard work in terms of, you know, the resource that we're putting into it, and also the partnering, that kind of longer term perspective. We're also very fortunate within Federated Hermes, within that EOS business. We're not just acting on behalf of our assets, we're also acting on behalf of other asset owners who use the EOS stewardship service. So that's something that is available to other asset owners. And so they're acting on behalf of over 1.5 trillion. And so therefore our voice is actually quite large. When we are even kind of asking for a conversation, when we're making certain requests, often that ability to drive the change and to you know, get good responses is helped by having those additional assets behind us as well.
Interesting. Can you put an example of a company that, let's say that you start trying to do some engagement and then finally you say, okay, it doesn't make sense being here and we exclude it. Can you put an example about it, please?
Yeah, so we've had a couple of examples over the years. You know, one actually is Volkswagen. That was obviously quite a big kind of high profile name that we did actually hold ahead of the Dieselgate scandal. And we did see some deterioration in terms of the governance. I think still the governance is not good, but even back then it was even worse, particularly when Volkswagen initially was doing very well in terms of its growth trajectory. And we were trying to push for some changes as very large shareholders at that time. And we saw, you know, some deterioration in some of the governance metrics that we looked at, and we actually sold out of the name because we weren't able to convince them sufficiently to put in a plan to change. We acknowledge that maybe they don't make the change overnight, but we need to get on board with the underlying kind of management about where they want to go and what they want to do. And I think at that time, when, you know, obviously the focus of Dieselgate was, you know, ambition with kind of no limitations and with kind of very limited risk and compliance in place to ensure that they were doing the right thing. And, you know, also acknowledging their scale at the time, that they had the resources to be able to do that, but were really so focused on, you know, their aim of delivering many more cars, that actually some of the other more quality issues obviously got left behind. So that was one where we divested and would obviously see kind of the deterioration. Outside of that, within emerging markets, we've had other examples where, you know, companies sometimes in emerging markets, they have a different framework. And so we're happy to invest with a company using a non-standard governance model, so long as we see that they're able to continue to talk to us about, particularly about succession, about that longer term strategy. And again, we had an example where there was a name that we felt wasn't particularly strong in terms of their kind of governance framework that they had, but they had a plan in place and that seemed to be okay. Having been invested for about 18 months or so, the company almost stopped talking to us, that they started to kind of evade our conversations, and they kept on kind of putting things off. They wouldn't let us speak to the same people. And again, so that was a kind of a red flag for us. And again, we kind of divested. And it's not that there are hundreds of examples. You know, I'm sure people would maybe talk about Wirecard, and I don't think we spotted that. We weren't invested. I don't think we'd got comfortable at all with where they were, but there were some who, you know, obviously got hurt as part of that scandal. Maybe that's another example where, you know, the governance didn't really stack up. But that was one that we decided to reject ahead of investment rather than divestment for following a deterioration or engagement failure, for example.
Interesting, very, very interesting examples. Yeah. Well, there is one sector that has been, and you were pointing it out before, that has been in the spotlight, which has been energy. And well, we've seen phobias and then investors willing to invest there because it's been a good performing sector in some specific months. So what has been your approach to energy, and how have you managed such a situation in the last years?
Yeah, so I think, you know, as I highlighted at the start, in terms of it's important to look at the company level, but also at the portfolio level, and also at the firm level in terms of the energy sector overall. So although within the energy sector, there are some companies which are better than others, those tend to be the European companies that get, you know, are better in terms of acknowledging the risk, in terms of having a plan. So that from a global standpoint tends to be our skew there. We have also seen a big divergence between the European and the US. So we have also had energy names in the US where we see them as best in class, because we see that within that local environment that they're also leaders, and can also add something in terms of, so for instance, the methane pledge that's come out of the US, and more recently even in terms of the support in terms of CCS in the US, those companies that are getting behind that development. So I think individually there are a couple of names that you could say are leaders within their field, that are thinking about how they lower their footprint, and particularly, you know, going to net zero for their scope 1 and 2 emissions at a minimum, and have a credible plan to get there. Scope 3 is obviously maybe a bit more challenging for them, and they're still working on it. And then at the portfolio level, so, you know, that total contribution to risk from being underweight the energy sector within, say, a global developed portfolio, that's pretty much doubled, you know, in the last year. And so in line with that, we know we've not wanted to take too much risk of being underweight that sector. There are obviously other names that kind of offset. And, you know, typically it would be the banks, the financials that offer a similar type exposure in terms of that kind of value, and that hasn't worked out so far this year, so that has been a headwind. But kind of going back to the energy sector, the final kind of piece of the puzzle is also continuing to push for better regulation, because at the end of the day, I think, you know, we have to, as investors, be pragmatic about the regulatory environment that we're currently operating in, even though we are pushing for more change, more regulation, you know, more global pricing, global kind of tax on carbon, for instance. And so therefore, again, we can get comfortable with those companies which are aligned to those same global goals of decarbonising, reducing the risk, etc. And having that engagement, having that depth of insight into those companies that are at the leading edge of that is also quite useful as well, such that we can get more comfortable with the risk perhaps than some other investors.
It makes sense. Well, having a diversified portfolio is important, of course, and you need to balance everything. So Yeah. Very good. I'm not sure if there are any other questions among the audience.
I can see there's a question in the chat. Sorry.
Yeah, I can't read it, so if you don't mind taking it.
Sure. So I'll just read it out. Have you or other portfolio managers at Federated Hermes found in practice instances in which applying ESG criteria was at odds with fiduciary responsibility? So I think it depends in terms of the outcome of the portfolio that you're looking to achieve. So for our 2 global equity funds that we have a primary objective of outperformance. And so therefore, you know, all these criteria are taken into account with the belief that, you know, and the evidence that we have that integrating these ESG factors adds value. And so that's why we're doing it. We do also run certain segregated accounts or kind of customized strategies for clients who are going beyond financial return and want to also rule out specific types of companies on top of that. And I think, you know, for those types of clients, that's typically within, you know, the client's wishes and what they want to. So that's their own kind of financial fiduciary responsibility. But when it comes to integrating environmental considerations, social considerations, governance considerations, we have the evidence to demonstrate why we're doing it. And we don't do it to, you know, we're doing it to outperform. We're doing it to help us deliver long-term outperformance. There may be particular periods where some of the factors are not as effective. But as I mentioned, if you do have this strength in governance, it is, you know, a very persistent signal. It does work, you know, across the broader universe. And so therefore governance as a key primary factor for that means that actually we don't see that there's any conflict there at all.
Okay, is there any other question among the audience?
No, I don't think so.
Okay.
One question we often get is maybe around the kind of the future of ESG and where we see things going. And maybe just to touch upon that, you know, some of the latest conversations that we've had is ensuring that we are focusing in on good governance as a leading practice. And I think that will become more robust as some of the EU frameworks in particular kind of get rolled out across the investment industry. There'll be more discussion about what that means and the implications. But also actually the idea that ESG is not one number, that it is more of a mosaic approach, and that in our communication with, you know, the underlying investors, it isn't just about carbon footprint, it isn't just about avoiding particular types of companies. It is about properly integrating a whole range of metrics that give us a better understanding of companies, their future trajectory, of where they're going as well. So maybe there might be less focus on ESG as a collective, and there might be more focus on those individual metrics of E, S, and G. And certainly that's how we embed it, that we don't want a company that looks good on average. We want a company that looks good in each of these things, because it's the weaknesses that can lead to failures within companies. And so we don't want any of those failures to take place, because at the end of the day, that's going to hurt the reputation, the profitability of these businesses. So it's important to really understand the kind of the wealth of data that's out there, and to have the resource to properly understand where those weaknesses might be and how those might materialize as well.
Very interesting, Luisa. Thank you very much. Okay, well, so Luis, Carlos, thank you very much for your time and for sharing with our audience your thoughts. It's been a pleasure having you in this event. And thank you everyone for coming to this conference. We hope to see you soon in our next event. Thank you very much all.
Thank you, Inigo. Thank you all. Bye.
Bye.
Thanks very much.
Thanks very much.